In this video, I want to continue with the topic of bond parameters or bond features, and the only one that's left out of the list, which is given by your curriculum, is the coupon rate and also the frequency of coupon payments. So I've called this payment frequency. Now, bonds typically come in two varieties when it comes to the way in which the coupon is expressed. Remember, the coupon is that systematic cash flow that is paid from issuer to investors, or may be paid. It's not always paid. So two, or actually three varieties, to be honest. First one is going to be bonds that have a fixed coupon. So fixed coupon bonds. These are frequently issued by governments, municipalities, corporations also. Now, fixed coupon bonds provide for a uniform payment. So the as the name suggests, there's going to be a fixed or uniform payment happening with a certain frequency. It could be annually, it could be semi-annually, quarterly, or even monthly from issuer to investors. In a moment, we'll have an opportunity to see how we calculate the size of a coupon. Now, the second type is going to be floating coupon bonds, which we often refer to, and this is how your curriculum calls them, floating rate notes. Floating rate notes, which basically means bonds that have a floating coupon or a variable coupon. This is often associated with the abbreviation FRN, floating rate notes, or FRNs. Now, in this case, the coupon rate is going to be provided or expressed as a formula, seeing as it varies from period to period. So the essential thing to appreciate here is that we'll need a certain benchmark. We call this the MRR, or that's at least how your curriculum calls it. This stands for the market reference rate. The market reference rate. MRR, and get used to seeing this in the text, in the curriculum, and possibly also in questions. And on top of this, the MRR, we also add an additional component called the credit spread, which will typically be provided in BPSs, or basis points. Don't worry, in a moment we'll do a question together that addresses these concepts with a proper computation. Now, the MRR, the first component, the market reference rate, is equal to the rate at which top quality borrowers borrow money. So this is the borrowing stroke lending rate. Borrowing and lending are two sides of the same relationship, the same debt relationship. So the borrowing lending rate for issuers that enjoy top quality or top credit worthiness, for issuers with the highest level of credit worthiness. This typically in most countries would be the government, although it's not necessarily the case. Now, in some countries, the government is not necessarily the most credit-worthy of borrowers, but in many countries that is indeed the case. So the important thing to appreciate is that the market reference rate has nothing to do with the issuer themselves. For example, if a company is issuing bonds with a floating coupon, a floating rate note, the market reference rate is going to be independent of that company, and it's going to basically reset periodically. So this resets periodically Typically, if, for example, the coupon is paid with a frequency of, let's say, every 3 months, so every quarter, then the market reference rate would also be reset every quarter, every 3 months. This obviously means it can go up or down, this market reference rate, causing also the coupon to accordingly also go up or down in line with what's happening to the market reference rate. In a question that we'll do in just a moment, you will see that I've used the example of the Euribor as a Europe or Eurozone specific market reference rate. Now, when you take the exam, but also if you look in the curriculum, you may find that the examiner doesn't give you a specific name for the market reference rate. They just call it the MRR, in which case you don't have to bother thinking about what it actually is. It's just a figure that you need to stick into the question. Now, let's go over to the right-hand side, the credit spread. This is, on the other hand, going to be issuer-specific. And it's an add-on on top of the market reference rate, which is supposed to reflect. So this reflects the actual credit worthiness of the issuer, reflects issuers' credit worthiness, meaning their quality, how trustworthy they are, credit worthiness. Okay, good. Or quality, you could say. Now, obviously, issuers with a high quality, good financial condition, which obviously also means that there is a high probability that they'll be able to make the promised payments on their bonds. They typically issue bonds where the credit spread is relatively low, or close to zero, given the fact that the highest quality issuers, typically the government, simply can borrow at the MRR without any credit spread added to this. Now, what's also important is that typically this stays constant over the life of the bond. Constant over the life of the bond or the note. So it doesn't adjust. This is the adjusting bit, the variable bit. This stays constant. And obviously, if the quality of the issuer subsequently changes once the bond has been issued, this may lead to certain price fluctuations, given the fact that the credit spread which was put in place at the time of issuance may not adequately any longer reflect the quality of the issuer once it changes up or down. Okay, but that's a topic for later modules. It will come up later on. Now, we also have a third type of coupon rate, although you could say it's a specific example of a fixed coupon, namely a zero coupon bond. So especially governments often issue bonds with a zero coupon, meaning they don't pay coupons at all, in which case, there's no periodic interest payments. Such bonds are typically issued below their nominal value, their par value, face value, principal value. So you buy them at a discount to their nominal value. And your reward for holding such a bond to maturity is the fact that at the end of the bond's life, you get the full nominal value. That's when you kind of receive the interest on the bond, but there is no systematic cash flow over its time to maturity. Okay, time for some questions now. So I'm going to clear the board and make space for 2 exam-style questions exploring the computation of coupons of a fixed nature as well as of a floating nature. So let's press ahead with the actual questions. This is the first one, focusing on a fixed coupon bond. If a $1,000 par value government bond, which is currently trading at a price of $980, pays a 4.5% coupon with semi-annual frequency, the size of the semi-annual coupon payment is closest to, and 3 options follow as in the CFA exam. Right, so over here you've got a little bit too much information as compared to what is actually needed. For example, this info on the, yeah, here it is, on the price at which the bond is trading, the $980, that's completely irrelevant to the question because the size of a coupon payment doesn't depend on the current price of a bond. It's a function of the coupon rate, this 4.5%, and the par value or principal value. So essentially what we need to do is take, and obviously also the frequency of payments. Now, the thing to really emphasize here is that when you are given a coupon rate, whatever it is, in this case, it was 4.5%. This is always per annum. It's always quoted on a yearly basis, irrespective of the actual coupon payment frequency. This will be given on a per annum, per year basis. So the size of the coupon, but critically, the annual coupon is going to be whatever that number is, 4.5%, multiplied by the nominal value or principal value or par value of the bond. So principal value, which in this case was $1,000. Good. Which obviously comes in at $45, doesn't it? Now, the only thing that remains is to compute the size of the semi-annual coupon, given the fact that these coupons are paid once every 6 months. And you don't really need a calculator for this, do you? You just divide this number by 2 to get 22.5 every 6 months. And that obviously becomes the answer to the question. It's going to be answer B over here. That's the one. That's the correct one. Okay, time for the second question. This one's going to be on floating rate notes, variable coupon bonds, a corporate FRN floating rate note currently trading at a price of 101.2. Now, once again, the price is irrelevant, and just bear in mind that when you're given a price like here 101.2, what that price actually means is not $101.2 euros or something like that. It's actually quoted as a percentage of principal, everything to do with bonds, like the coupon rate, but also the price at which a bond trades is going to be expressed as a percentage of principal value or face value or par value. So if in the second half of the sentence we're told it has a face value of 1,000, if you were to calculate its price, you would need to take 101.2% of 1,000, which would give you 1,012. Okay, as I said, that's not really the point. The bond pays a quarterly coupon at a rate equal to 3-month Euribor plus 28 BPS. So Euribor, 3-month Euribor would be our market reference rate, 28 basis points, each basis point being 100%. So this is 0.28% is effectively the credit spread that we add above the MRR. If the 3-month Euribor rate applicable to the current quarter is 3.98%, the size of the coupon payable for the period is closest to. Right, this isn't difficult, but once again, you have to bear in mind the fact that we have to scale things down to a quarter, whereas everything provided like Euribor, even though it says 3-month Euribor, it's actually an annualized rate. Get used to the fact that in finance we annualize pretty much everything. So the coupon rate is 3-month Euribor, the MRR plus 28 basis points. Yeah, so 0.28%. That's what we mean by basis points. 100% is 1 basis point. Now, for this, we need to plug in 3.98%. Yes, that's it. So maybe now I'm going to use my calculator as to avoid making a mistake. So 3.98 plus 0.28, that's going to give a result of 4.26%. But this is once again per annum. And we need to turn this into a quarterly number, don't we? So actually, maybe before I even do that, let me multiply, as always, by the principal amount. Be careful, don't multiply ever by the current price. The only time when you'd use the current price is if you were doing something like a current yield computation, which is something I'll show you in a moment. That's to do not with computing the coupon size, but the yield, the rate of return on a bond. You'll see that in a moment. 4.26 times 1,000, that's obviously 42.660 euros, once again, per annum, per year. But we need to turn this into a quarterly figure. So wait, 42.60, but divide this by 4. Yeah. Because this bond pays coupons with a quarterly frequency, so 10.65 euros in respect of the current quarter in which we are observing that specific Euribor. So the answer here would be answer A. And let me just stress that with FRNs, with floating rate notes, what you would do every quarter is take an updated reading of the MRR. In this case, it's the 3-month Euribor, and plug that into the formula, do all these workings, and you would get a fresh current coupon. So it's not as if this coupon stays fixed for the whole year and gets paid at 10.65 4 times in a row, and then something else comes in. No, we update this every quarter. So even though we say per annum per year here, it's only for the purposes of computing the quarterly coupon, which changes every 3 months as we get an updating reading of 3-month Euribor. Okay, so I want to finish this video off with a quick look at some very basic yield measures, seeing as these are also talked about in your curriculum in this section of the book. So just two very quick yield measures. The first one's going to be the current yield, and then we're going to have the yield to maturity. But please be aware of the fact that there will be more on these yield measures in subsequent sections of the curriculum as well. They will be expanded on. So here it's just a very brief look. For some reason, the authors of the curriculum decided to already put some knowledge about this at this very early stage. So the current yield is an expression that takes into account the annual coupon, right? Not quarterly, not semi-annual, but whatever is the annual coupon, so the full one that you get by taking the coupon rate and multiplying by principal value, and you divide, and this time, this is where you divide by the actual bond price, whatever it is, and this is where the price actually comes in handy as opposed to principal value. And obviously, if the bond price goes up, the yield or the current yield on the bond decreases as you would expect with any rate of return on an investment. So if you get a question on this, you have to make sure you're plugging in both numbers consistently. So if you've got a coupon rate, then over here you should have a bond price expressed as a percentage of nominal value. So like 4.65 here of nominal value, 4.65%, and over here bond price maybe 101.2% of nominal value. Or you could go just as well with both the numerator and denominator being expressed in monetary units like euros or dollars, but you have to be consistent. And the second one that you already need to know about, and there will be plenty more on this to come, is the yield to maturity, known as the yield to maturity, known as the YTM. M. You'll be doing plenty of computations on this using your calculators later on. And this is realistically the internal rate of return, or the IRR, something that you'll also be learning about, for example, in the corporate issuers section of the curriculum. IRR, internal rate of return on the bond investment, so of the bond investment. But very critically, assuming that it is held until maturity, so you go all the way to receive on the maturity date the full principal value of the bond back. So IRR of bond investment, meaning it's kind of the rate of return experienced by the bond investor, but already I want you to be aware of certain limitations here, certain conditions that need to hold true in order for this to really be a good measure of the rate of return as experienced by the bond investors. First of all, in order for this to be the case, in order for the IRR to be the good representation of that yield or rate of return experienced by the investor, we have to assume that the bond is obviously held to maturity. That's kind of contained in the name. The bond is held to maturity. In other words, it's not sold before the maturity date, in which case it can be sold for an unknown price. The thing about holding the bond until maturity is you know how much you will get at the maturity date, because that's given by the principal value or the principal amount of the bond. The second point is, we have to assume that all the payments, all the contractual payments on the bond, meaning coupons, but also principal value at the end, are received in full and on time. So there are no delinquencies, there are no defaults in full and on time. And the third point, which is kind of the most technical point, and it's something very critical that you may get asked about in the exam, both in terms of the fixed income section of the curriculum, but also the corporate issuers, where IRR, internal rate of return, is a sort of bigger topic, is that all the payments that you receive throughout the life of the bond, so the coupons received, the interim payments before the maturity date, are reinvested at a rate equal to the YTM, the yield to maturity. So an IRR, which is what the YTMS essentially is, only holds true if you reinvest all the intermittent cash flows at the same rate of investment as the yield to maturity, which isn't necessarily always possible, but it is a critical assumption of this measure. Now, we're not going to do any computations of the YTM here. We'll do so in a subsequent section of the video course, but this is something which your curriculum lays out at this very early stage, so I wanted to get this down, and probably in the future I'll reference it anyway. So one final thing. Currently we've got the yield to maturity, and let's just press ahead with this topic a little bit to introduce the concept of the yield curve, which once again your curriculum talks about at this very early stage. So what's the yield curve? The yield curve is basically a graphical way to represent or to show the yields to maturity of bonds coming from the same issuer, but with different maturities. So maybe I'll write this down. It's a graphical representation of the yield to maturities, YTMs, of various issues bond issues, obviously, but from the same issuer, critically, of various bond issues from same issuer, but with different tenors, meaning different times to maturity. So the classic way to represent this is as follows: is to draw a graph on which on the vertical axis you'd have the actual YTM, the yield to maturity, and over here you'd have the tenors, the time remaining to maturity. And for different maturity, and for different bond issues, you would plot their time remaining to maturity, you know, maybe 1 year, 2 years, 3 years, and so on, and how much yield we get given you know, the IRR computation. So thanks to this, you'd be able to plot certain points on this chart. And what I'm going to do is draw what's called an upward didn't come out great, but it's an upward sloping yield curve, which is considered to be normal. However, it's just as possible that in reality you would experience a downward sloping, or you'd see a downward sloping yield curve in the economy. And in later sections of the videos, we'll talk about how to interpret the yield curve, what theories allow us to gain insights into why this is happening, why this shape is a certain way or another. However, an upward sloping yield curve like the one I've just drawn, upward sloping yield curve, which is considered to be a relatively normal phenomenon, means that investors expect to get higher returns, as expressed by the YTM, for holding bonds that have a longer maturity. So the longer the maturity, time to maturity, the more they expect to get out of them, the higher the return. And another point is that typically what you would plot is a government yield curve, obviously on the basis of YTM computations done with government bonds, but also you could plot a yield curve coming using bonds coming from a corporate issuer. And the normal thing to experience or to expect is that if you have a corporate issuer or a corporate issuer yield curve, those yields should be a little bit higher than those plotted on the basis of government bonds, because of the extra sort of risk associated with buying corporate bonds. See this area here, the additional yield is due to the extra risk posed by corporate issuers, as opposed to government issuers, who are supposed to be typically the highest sort of quality out there. So yeah, I think that's enough. I've covered pretty much everything that the curriculum talks about with respect to coupons, coupon rates, coupon structures, payment frequencies, but also basic yield measures.